Good morning and welcome. Thank you very much for joining us again. My name is Henk Heymand and I am the National Quality Leader for RSM South Africa. I'm also the head of our technical department, so that is why I am facilitating this session today. This is the second of these sessions where we kick the year off with a look at what we can expect for the year ahead. It's sitting nicely almost halfway between the beginning of the year, the December break and the madness of holidays, and the budget speech that's coming in a few weeks. So hopefully everyone has been able to find their feet in 2024, but are not yet too overwhelmed to think tactically. This is an opportunity for you to sit back and think about your tactics and how you're going to face what's happening this year. It feels like yesterday that we had our previous session. But what a year it has been. I think for us and for myself personally, it's been hectic. And so far, it doesn't look like 2024 is going to disappoint us in terms of excitement either. So Maarten will tell us what to look at. Nobody's got a crystal ball handy, but Maarten and his team have again analyzed the indicators. They've been hard at work the first few weeks of this year, and they've come up with some ideas of what we can expect. You're welcome to type your questions in the chat box. We are probably not going to be able to get to all the questions because, as I say, we've got a full agenda. There's a lot to share with you, but what we get to, we will do at the end of the session if there is time. So please allow me to introduce Maarten again. And if you don't mind, I'm just going to read his CV because he's given me quite a short CV, a resume. And last year I summarized it, and as I go through it, as Maarten starts talking, I go, oh my goodness, I should have said this, I should have said that. And there's a few very impressive words in there. So let me just read it. Maarten joined Citadel in October 2003, part of the advisory and asset management teams, responsible for global and local economic strategy and global portfolio construction. And he manages the Citadel range of global objective matching portfolios. This is where I'm getting into those important words. Maarten is an advisor to a member of Citadel's ultra-high net worth clients. He's also a member of the Chartered Institute of Securities and Investments in London and a faculty member at the University of Stellenbosch Business School, Executive Development. Maarten holds a master's degree in econometrics from the University of Pretoria and lectured at the University of Pretoria and the University of Stellenbosch before joining the Bureau for Economic Research in 1998, where he focused on macroeconomic forecasting. Prior to joining Citadel, he was a portfolio manager at Peregrine Quant from 1999 to 2003. So I think you'll agree Maarten is very well qualified to speak to us about it. Unfortunately, Maarten doesn't use these big words. He's got a very nice way of getting the information across. So Maarten, what Maarten does is, like last year, he looks at seasons. If you can see the slide here, he looks at the 4 seasons of the economy. So first he's going to look at the economy, big picture. Then he's going to look at the markets, slightly smaller picture, and then he's going to look at your personal life. And then right at the end, the 4th sort of season is 2024. What can we expect for 2024? So there's going to be 4 sections, and I'm going to hand over to Maarten to get started with the economy. Thanks, Maarten.
Thank you, Henk, and thank you for the introduction. And again, thank you for the opportunity to share our view with your clients. We really appreciate this opportunity every year. You're 100% right that last year was an exciting year in very, very ways. And this year, I think, is going to be pretty much the same. So a little bit of deja vu as we're standing at the beginning of this year compared to what we were thinking at the beginning of 2023. So let's jump right into that. Maybe you can just confirm that you actually see the 2024 economic landscape slide.
Yes, we can see it, the tree with the 4 seasons.
Perfect. So what we typically do at the beginning of each year, the team sits down and we just dot down a couple of themes that we believe is going to play out during the course of the year. Maybe not only this year, but probably for the next decade. Some of these are going to be on the front pages of most news lines. And we look at these because it helps us to focus where we need to look for opportunities, but also to identify risks, and also keep in mind that with every risk, there is an opportunity. So this is a list of our 10 themes for 2024. I'm not going to go into detail in all of them, but just so that you can understand what the economic landscape tends to look like for the year ahead. So we start with the first one, economic uncertainty 2.1. That's just basically saying that, the economic uncertainty that we had last year is, we didn't avoid a recession. It was probably just delayed into this year. We'll unpack that a little bit more later. We in a year where we believe there is going to be a pivot in interest rates. Last year's been a massive increase in rates on the back of inflation. Given recent trends in inflation, those interest rates can start to decline. The market consensus is for the US probably 6 cuts this year starting in March. We think that's a little bit on the optimistic side. There's a bit of sticky inflation still in the pipeline. If you add to that what's happening in the Red Sea with the shipping industry, that is quite inflationary. So probably cuts in the second half of this year, but that is very important for markets. We're still concerned about a potential debt crisis. With these kind of high rates, we haven't seen real impact on consumers or corporates or governments for that matter. So that is still a risk that one needs to monitor very closely. China is not boiling over, probably disappointing in terms of their recovery after COVID. This is very important. We're seeing a massive election year. There's more than 70 countries that's going to have elections this year. That implies that more than half of the global population will be able to go and vote. Now, given where we are in the geopolitical environment, you can just imagine that there is definitely going to be some fireworks. There's already early signs of that in terms of the right-wing parties that's building momentum, especially in Europe. And more talks about other European countries potentially also leaving the EU. So this is going to be quite an important theme to watch throughout this year. This includes our own elections, which is going to come with its own fireworks. And also the most important one probably is what's going to happen in the US in November, and whether Trump is going to get that second term. There's already a couple of regional conflicts around the world. We're very concerned about the Middle East conflict with the Israelis. That is probably not just regional. If you look at all the people around the world rioting, having marches from Washington to London, this is much deeper than just a regional conflict. Supply diversification is crucial. This is especially after COVID, where companies and countries are moving production closer to home. That is also inflationary, then, because that's not necessarily at the cheapest point. The race for green resources, the race is towards Africa. The West and the East is basically racing to Africa. Africa sits with many other resources that's required for this green revolution. So that is going to add to the conflict, but it's also creating a massive opportunity. Artificial intelligence we'll touch on later. I'm talking here specifically about the tailwind markets had last year with all those companies performing so well. It's very difficult for those companies to continue performing that well from a market point of view. Technology, the artificial intelligence technology, that's a game changer. That is definitely going to increase productivity, and that is going to bail out especially Asian countries like Japan, where they can make use of this to increase their productivity. Last year on SA, I already mentioned it's an election year. That means pretty much gridlock in terms of policy reform up until the election. If you think about the most likely outcome with coalition parties, a continuation of that political gridlock. So, yeah, unfortunately, we're not going to see massive changes or attempts to resolve our structural issues, but we'll also briefly touch on that. So if you just run through that list without going into too much detail, you can see that 2024 is going to be another eventful year rather, with a lot of geopolitical issues that's just going to add to that mix of volatility. Let's quickly jump into the seasons of the economy. Now, just like in normal seasons, you need to know two things to understand what the day is going to look like. Sitting in Cape Town at the moment, the only thing we ask is what the temperature is going to be, because we're running close to 35 to 40 degrees on a day. And you're not really concerned about the rainfall. But in the winter, you will also ask what the rainfall is going to be like. So if you understand what the rain is going to be like and the temperature, you've got a fair idea of, call it the season or the weather pattern for that day. From an economic point of view, pretty much the same. If we can understand what's going to happen with inflation, either deflation or inflation, and with economic growth, sustainable growth, or then no growth or stagnation, we can very easily define the 4 economic seasons. The one is good deflation, where you have very strong or sustainable growth, but prices are going down for the right reason. Think about when China joined the World Trade Organization and we had good deflation, things got cheaper because of the amount of labor that entered the global labor force. Summer, if you like, is Goldilocks, where you've got strong growth, not high inflation, but stable inflation. And really the winter is where you've got negative deflation. So that's now the opposite of good deflation, where prices are actually going down because there's no demand. Consumers aren't going to the shops, and there's sales going on to try and stimulate demand. And also there's no growth. And then you've got stagnation, where there's a sticky high inflation and also no growth. So what I want to do in the next couple of slides is just to paint the picture where we think the world is going to be for the next 3 years, 2 to 3 years, in terms of this economic landscape. As soon as we understand the weather, the economic weather, then obviously we can decide what to do in our portfolio. So if we know that it's going to be a rainy day, we can walk out with an umbrella and make sure that we're covered for that. So that's pretty much the same kind of analysis that we want to do here. Just very quickly, why is economic growth so important? Well, because the stronger the economy grows, the more profit companies can make. And we want to make sure that we benefit from that profitability by getting dividends and also by the share price going up. So if we're in an environment where we think growth is going to be quite slack, then we need to understand that that's going to be a headwind for company profitability, and we need to adjust the portfolio accordingly. So what is going to happen with growth? Where we stand right now, this is your 4 big countries, the G4. The leading indicator, which is this one, is for the G7. That is looking forward for the next 18 to 24 months. It is telling us that the world is going to bottom the economic cycle this year. And then, fortunately, there's already some upside again going into 2025. So put that into the seasons. This year, we can expect an economic winter, if you like. But we know that spring is definitely going into 2025. What we also know is that the winter is not going to be as bad as COVID. This one was much deeper. There was obviously an external event that added to that. And it's also not going to be as bad as the financial crisis in 2008. That was a major crisis where we had the Lehman Brothers going belly up. So it is going to be winter this year, but not as bad as the previous two. If we look at the actual growth in these economies, excluding the US, the others are already flirting with recession. They're basically on zero. Germany's already in recession. They will pull Europe into recession as well. We think US is a matter of time. The reason why the US is a little bit stronger for now is simply because they had much more stimulus during COVID. That ended up in their bank accounts. So as interest rates went up last year, the US consumer didn't really feel that those savings to tap into, but most of those savings are now depleted. Interest rates are still quite high, so we're already starting to see some signs that the US consumer is battling. If you think about retail sales, if you think about how many consumers are defaulting on their credit cards, their vehicle payments, so that's early signs that the US haven't avoided a recession and is probably going to experience a similar slowdown this year. If you think about the emerging markets, the rest of the world, unfortunately, SA, well, on a year basis, we're in recession. And you can see that we really not comparing to our peer group. It is mainly Russia, India, and China that's keeping up the emerging market flag. Russia, after the sanctions, went into recession, but they're now back. They're pretty much somewhere between India and China. And this is not with the West. They've opened up other markets, and that's why the new BRIC bloc is so important. Africa is a major trading partner for them right now. So there you can see that the emerging markets, excluding South Africa, is likely to perform reasonably well this year. Just quickly on SA, how do we turn the current winter in SA into spring? I think this is very important. What you're looking at here is fixed capital formation. So that's how much companies are willing to invest in the economy as a percentage of the economy. We picked at close to 20%. That was just before the state capture years really kicked in. During those years, no one wanted to invest given the uncertainty. So they either pay dividends, move the money abroad. But if you don't invest in your infrastructure for a decade, then no surprise, you've got issues with electricity, you've got issues at the ports, and. Fortunately, this turned around. We're now at 7 positive quarters. You could probably argue this is the private sector realizing that, well, if they don't going to do anything, then they can just as well close their business and moving elsewhere. My point is that if this line is not growing and keep growing up until China is running at 25%, we won't get sustainable growth. We need to rebuild capacity from our electricity networks to the ports and the road and rail, you add that, before we can get sustainable growth. We had a bit of a blip in the last quarter, but that's coming off a very high base, given the solar spike, if you like, in terms of solar coming into the country in the second quarter of last year. So our expectation is that this trend will continue going forward. So we monitor this very closely, and this is a very positive sign in terms of things happening on the ground. So that's on the economic side. On the inflation side, the other variable that we need to understand, obviously, we had the spike in inflation globally that came on the back of COVID and also the war in Russia, Ukraine. The central banks looked at this, they started hiking interest rates, and it seems like it's working. But like I said, this is headline inflation. If you look at core inflation, so if you strip out the two main components that caused the spike, which is food and energy, core inflation is still sitting on average around about 4%. And central banks want that to be closer to 2%. So we're not there yet, but this is definitely paving the way for central banks to start cutting rates. And that is why the market expects that we will see that pivot in interest rates during the course of this year. But still some work that needs to be done. If you look at this, this is a 10-year interest rate in the US, a 10-year bond. There you can see the massive increase in interest rates. And that's why I've said, well, if you have this kind of increase in rates, this is much more than we saw anything in the past, going from the bottom to the top. It's been double that and twice the speed, and we haven't seen real impact on the economy. That's why we say that we don't believe the US economy can avoid a recession. It is probably going to happen. And we spoke about peak rates. Typically, when these rates peak and they turn around, like all these circles indicate, you have some crisis. Why is that the case? Well, because at that point in time, there's so much liquidity given being sucked out of the financial system, given the tightness of policy, the high interest rates as a result, that some crisis can unfold. So for now, there's a question mark. This goes back to our third point on our themes for 2024. We do think we're going to put in some wording there for this year. It might not be as bad a crisis as the great financial crisis, but at these levels, we need to plan for a potential event that can play out, especially if you overlay the geopolitical landscape. Our numbers at the moment, I'm not going to go into too much detail, but this is our growth numbers for these countries for the next 3 years. That's the inflation numbers. Let's just look at the global. I think that's the important one. So we see growth at 2.4%. What does that mean? Well, that's about 1% less than what we saw in the last 10 years. So we're talking about lower growth for the next couple of years compared to what we had. So that's a bit of a headwind. Inflation is sitting at 2.6, closer to 3%, where over the last 10 years, we were closer to 2%. So we're sitting with lower growth and slightly higher inflation. So back to our weather chart, that implies that Citadel's view is that the world is going to be stuck in a bit of a stagflation scenario for the next 2 to 3 years, where we battle with sticky inflation and where growth is really struggling to take off. And in that environment, we then need to think about what do we do in terms of portfolios. Just quickly on the geopolitical front, obviously geopolitics are like a heat wave or a cold front when you talk about seasons, and we're in an environment where we can expect a lot of those heat waves, if you like. So that goes from the G7 being concerned about the BRICS being added to the G20, the G20 removing the criticism against Russia, the recent turmoil in the Middle East, Trump being back. When I say Trump or they, Geert Wilders on your right-hand side in the Netherlands came in last year. They both call it more populist. Geert Wilders in the Netherlands are flirting with exiting Europe with a referendum. And just this week, the Alternative for Germany, similar kind of messages of potentially trying to exit the European Union. So we can speak the whole day on that, but geopolitics are going to add quite a bit. So that's the economic session. Henk, I don't know if you want to run through the summary or how you want to do that. Just unmute.
Sorry about that. Yeah, let me just quickly summarize what I heard. Maarten, you can just put all those notes up on the screen. So Maarten discussed basically the global growth. I think where the message is that we're at the end of the winter. We're going to have a bit of winter still coming before spring starts. And Maarten, unlike you, I'm in Johannesburg. And yeah, our winter normally has one final big kick. When we think it's over, there's another kick. So I think what you said about the geopolitical scenario just adds to that. It is going to be interesting, to say the least, this last bit of winter that we have. In terms of growth, we are lagging. And unfortunately, the message that Maarten has given is that our structural issues need to be resolved before that can be fixed. So that will be your Eskom and your roads and your infrastructure and our harbors and things like that. Global inflation, this is one area where I get a completely different feeling this year from what I had last year. Last year, global inflation was high. Everyone was feeling the strain. Now you can see that it's moderating, but it's still above target. So therefore, we can expect interest rates to remain a little bit higher for a while, and then let's see what happens after that. Hopefully, spring will come. So that's as far as the economic summary is concerned. Next, Maarten is going to his next season, and that is to look at the market specific. We've looked at the economy, now we're going to look at the market specific.
Thanks, Henk. Yeah, so given that economic landscape, which is probably not great, but it's not the end of the world because we know spring is coming. How do we prepare our portfolios for that? Well, we're fortunate this time around that interest rates normalized. So a couple of years ago, if you were concerned about the future, you couldn't really keep money in the bank because there were no interest. Which then forced a lot of investors to remain in equity markets and just stomach the volatility. Where we are right now, very simply, if you look at risk, low to high potential return, we're looking for three years here on average. Money in the bank, you could probably get about 9% currently in cash. Our income fund with Citadel pays about 10%. You need to keep in mind that you'll pay tax on that interest unless you put it in a tax-friendly product like a tax-free savings account or your retirement annuity. Think about inflation being what the number printed this week, I think 5.2. This is a great investment. Right now, to make use of these high rates in the right part of your portfolio, beating inflation, definitely something that one needs to consider. Second option is to put it into government bonds, so basically lending the money to the government. Given the risk, the fiscal squeeze, the budget, investors demand to be compensated for that. So you can see there's a nice pickup in terms of the additional risk that you take to go into the government bond space. A lot of clients ask us, what's the risk of the government defaulting? Not yet. 20% or 20% rather of our budget is going to interest payment. So it's already quite high because it implies that we only got 80% of the budget to spend on other things. Now that number is going to increase. Already they expect that to go to about 22%. But your risk of default is only when you get north of 30, close to 40%, because then government really needs to borrow money just to pay the interest. We're not there yet. So we still think this is a reasonable investment opportunity. Or then you can put your money in the JSE. Now here you can see that talking about winter, you're taking a lot more risk currently to go into the equity space, a little bit of a big pickup, and one needs to ask yourself, is that risk really worth it for that additional pickup in potential return? So already you can see in terms of winter, we light on equity, so we're underweight equity in most of our solutions, and we're more overweight towards your fixed income cash and bonds for now. We want the cash and the bonds because as that spring arrives, which will happen, you want to have that dry ammo to then go into the equity markets again. If we do a similar analysis on the dollar side or the offshore side, US cash currently closer to 5%, but if you look at 3 years, there's probably going to be some rate cuts, so an average of about 4%. US bonds sitting at about 5%. So again, these are currently in dollar terms very attractive because we haven't had any of those rates for the last couple of years. And then if you look at global equity, it's even more unattractive. So you take a lot more risk you only get about 1% pickup to go into global equity. And that's just talking to the winter that we approach. It talks to the very strong numbers we saw in 2023. So we're coming off a very high base. Equity markets in dollars last year printed about 24%. It's been an exceptional year, so you can't expect that same kind of return again. If you break up the global market, there's a bit of a divergence, if you like. You know, the US been running exceptionally strong on the back of the tech companies. At some point, you know, coming off that high base, their potential return going forward, this is looking forward, is probably going to be slightly lower compared to places like Europe, where from a valuation point of view, there's a bit of a pickup potential going forward. And this is what I'm talking about. So if you look at last year, this is only from Jan 2023 to the end. You probably heard about the Magnificent Seven. So that's all the artificial intelligence related kind of companies, the tech companies. So those 7 companies last year did more than 70% in dollars. If we exclude them, then you're basically sitting with the 2 lines here at the bottom. So you're talking about 10%. So global markets last year, the double digits that we see, this 24%, was mostly as a result of these 7 companies. And like I've said on our themes for 2024, we're not talking about the technology. The technology is going to stay, it's going to get better, it's going to change our lives. But we believe that the market already priced in that benefit to a large extent, and you can't expect a similar kind of performance going forward. So a little bit of a blowing off steam there, which implies that the total market is probably going to print low single digits, especially as we enter winter as well. Just another way to look at it, our team look at all the companies globally listed. They then quickly divide them on different times into these categories. So fair value, implying that you get what you pay for. Growth, they're getting expensive in terms of what they put on the table. And value, obviously, the Warren Buffett kind of believes that you're buying it at a discount. There's some buffer of safety. Right now, if you look at that, a lot of companies are getting expensive. There's not a lot of cheap ones left, and that talks to this market being quite frothy. And this is probably why we're concerned that going into winter, you need to have a little bit more green margin of safety. So what we are doing in our portfolios, we recycle. So we sell some of the red, we buy some of the green, but to try and stay in the theme. So as an example, if you think about Tesla, electric vehicles, that's not going to disappear. But Tesla is now quite expensive given the theme. Now you just go down the supply chain, other companies that supply into Tesla, that's still trading at a discount. You buy those companies, they will benefit from the theme as well, but they're not fully priced yet. Quickly on the Rand is obviously the link then between local and offshore. Last year, the Rand added about 10% to any dollar exposure, given the currency weakness that we saw. You know, the Rand is quite volatile. We can again spend the whole day talking about this. I just want to make a couple of points. We're in an election year. Election years, not good for the Rand. The Rand remain under pressure given the uncertainty. And then after the election, irrespective of the outcome, the Rand typically breathes it a little bit because the market knows what they are dealing with. So political uncertainty will put pressure on the Rand. The budget is under strain. That's Rand negative. You can just go back a week ago, the Rand was still strongly below 19. Our Minister of Finance started talking at Davos, and the Rand went above 19. Not because of him, he's a great Minister of Finance, but because the questions they've asked and the answers he gave clearly indicated that it's going to be a difficult budget. We're in a corner. They're going to need to pull a couple of rabbits out of their hats. How are we going to balance this budget? And the currency market didn't like that. And then, unfortunately, right now in this geopolitical environment, our government tends to pick sides and have comments about some of the conflicts around the world. And every time that happens, it puts the currency under further pressure. So that previous high there of 1992 was when the Lady R news came out. That was then breaking that 1935. Remember, that was the Friday night before as we went into lockdown. We were also downgraded to sub-investment grade. What we do know is that the Rand never stays there. Well, if you go back to that point, it felt like it's the end of the world because we were facing COVID. Our country was downgraded to junk. And despite that very challenging next 2 years, we went all the way down to 13. This gray block here is our view for the medium term. So currency is currently above 19, but we think the currency in this environment next 6 months will be somewhere between 1850 and 2050. It's quite a wide range, but there's a lot of things that can play out. And then going to the second half of this year, if the central banks are starting to cut rates, we go through that economic bottom, there's some pickup in commodity demand. There is a chance that the currency can again trade in this bottom range, but that is a later year story rather than the next 6 months. So for now, we are preparing for a weaker currency. We won't buy dollars for our clients to externalize if it's not below 1850. And while it's in this range, we do a lot of dynamic currency hedging to make sure that we use the currency also as an asset class.
Okay.
So that's roughly.
Thanks, Maarten. So as far as the market is concerned, I think Maarten started it with the introduction. We're still in winter. So what you do in winter, you make sure that you have enough dry wood to last through this last part of winter and to also get going quickly when spring comes. So it's, as the Americans would say, if you follow international or American football, it's time for blocking and tackling. So be a little bit more defensive, slightly underweight on equity and growth assets, diversify and hedge. You can see on Maarten's last slide that there's a possibility that the currency can weaken slightly more, not so much, but you can see the area where it's going to be trading or where we think it's going to be trading. So it's the time for hedging. So now Maarten is going to go a little bit closer to home and look at your personal portfolio. What do you do with all that dry wood?
Thanks, Henk. Yeah, so in this, the portfolio for all seasons, or then the seasons of your life, you know, the economy is one thing, markets is another thing. But then there's other things that we need to be worried about. Markets and economies go through cycles. But as investors, you know, we tend to live longer these days. So you need to make sure that you save enough money to take you to the end of your life. Inflation is a struggle. Well, it's always a struggle, but even more so these days. So your portfolio need to beat inflation. And then we're in an environment, especially in SA, where taxes are going up. So your portfolio also needs to make sure that they can actually weather that. So in terms of your personal life seasons, so, you know, at the moment, most people, if they're fortunate, live somewhere past 90. These days, more and more people get to 100 and even past that. But let's just assume that that is a normal life cycle. You can very easily break that up into learning, earning, and retirement. My gut feel is that everyone on this webinar today is still in the earnings phase. While we earn, we also learn, so don't make that mistake. Retirement typically is at the age somewhere between 60 and 65, but you know that is really changing. And at Citadel, we like to change the retirement wording to that's actually a point where you choose not to work anymore and you're able to afford it. That's so important. So we're seeing in our client base that some clients work to 80 because there's purpose and they enjoy what they do. And we see some clients which have the ability to do that, retires at 50 because they want to spend more time with their family or the kids or whatever the case might be. So retirement is not an age anymore. It's a point in your life cycle where you choose that's enough. I want to do something else. And then you should be able to afford it. When we talk about affordability, what do we mean? Well, in this phase of your life, you earn something, a salary, a business, making profit, a bonus, dividends, whatever the case might be. And whenever you decide to stop, sell the business or stop from corporate employment, those expenses will continue to go. Expenses might be different. You know, at this stage, they might be buying a house, looking after the kids. But the point here is that the minute you make that choice, you need to make sure that there's sufficient capital so that you can maintain your expenses, your lifestyle until the end of your life cycle. So how do we typically do that? Well, if you just go back to this diagram where we said, very simply speaking, you have the option of cash, bonds, and equity. Irrespective of what we just spoke about, how much is offered by cash, bonds, and equity, where do we put the money? So our philosophy is to say, well, it depends on your lifestyle. So how much money do you need? When do you need that? That money you don't want in the market because either market sells off like we had during COVID, and you need to pay for your daughter's wedding, then you're a forced seller and you lock in that loss. So it's all about the cash flow planning or having a budget. So simply what we do is to say that all the money that you need for the next 2 years, that should be in cash. So right now, if you start at the other point and you argue that cash is so attractive, a lot of investors are putting all their money in cash. But the reality is that cash, you're not going to beat inflation. So that's actually the wrong decision. So what you need to do is to say, well, if I do need cash for the next 2 years, how much do I need? That goes into a stable category, if you like, where there's no volatility. You're not too concerned that for the next 2 years, you're not going to beat inflation. And then you know the money is safe, irrespective of what happens in markets. When that expense comes, you can make that payment. So in a situation where you still work, that already should give you an answer to say, well, don't have too much in cash because you don't need it. You get a salary. Rather, let that money work on your behalf longer term. The money that you need for the next 4 to 6 years, that goes into what we call prudent. So you start taking some risk. So there will be some volatility. You want to beat inflation, but that's still a shock absorber. And then the rest, talking about a long-term investor, everything goes in growth/equity. So if you have time on your side, so you're still working, you're saving for retirement, there's still 10, 15 years ahead of yourself, irrespective of what I've said now in terms of the economy going into winter and where markets are, you should be in markets because we can't time the market. It's having time in the market, which is so important. We know it's volatile, but you shouldn't worry about it because time is your friend. And I can tell you right now, over 8 years, you will beat inflation per year. That's a guarantee. What we do from an asset management point of view, so if you've got everything in equity right now, we are approaching winter. It's not like you don't do anything. You will make sure that you have more defensive companies, that you have companies that's quality, low debt to equity with high interest rates. So it's a much more defensive portfolio, but it's still the growth component that will benefit when that turnaround comes in terms of when spring arrives. So that's how we will construct a portfolio. Pretty differently for each and every person on this webinar. They've got a very different objective. And the magic of diversification is to say, well, you can put all your money in cash. And like I showed you can probably get about a 9, I call it a 12 in bonds and slightly more in equity. But the minute you go into multi-asset, you get this kind of benefit. So you can actually pick that portfolio where you get bond-like returns, but you take the same risk as cash. So as an example, we've got a fund called the stable fund. Because it's in the fund, you don't pay tax on the interest because the interest is earned by the fund. So you will only pay tax if you sell units in the fund, and then it will be a capital gains tax. So now we have the benefit that in that stable fund right now, we've got a fair chunk of that 10% that's in the income fund. So that's your cash-like return. We've got a fair chunk of bonds that gives you about 13, and we've got some equity. So that fund will give you double digits, handsomely beat inflation, but your risk budget is still very intact. Alternatively, you can look at a portfolio like this where you're happy with bond-like risk, but you get much better returns because, again, you add some multi-assets to that portfolio. So that's the magic or the art of just putting all of this together and then construct a portfolio that is appropriate to your circumstances.
Thanks, Maarten. That was really insightful, especially that last slide I found very interesting on how portfolios are constructed. And if I think back at where Maarten started, one of his first comments was, it really struck me, is that for every risk, there's an opportunity. But what you need here is someone to help you face that. And I think if you allow me a moment of marketing, with Citadel and RSM together, you've got the partners to help you with this. At RSM, our strategy is instilling confidence in a world of change. So we say that we are here to help you overcome these challenges and turn them into opportunities. Take the change and adapt to it and thrive and do better. So together with our partner Citadel, I think it's the right place to be. If we can help you, please let us know. So with that, I want to say in the winter that's coming, stay dry if you're in Cape Town, and stay warm. And we'll speak soon. Thank you very much, Maarten, for that presentation, and thank everyone for attending.